Hey everybody, welcome. In today's video, we're going to talk about why does Dave Ramsey hate whole life insurance so much? I actually kind of agree with him on a few points. I'm an insurance agent. I specialize in infinite banking. I agree with him on some of his points. I'll show you why here in a second. Let's get into it. It is YouTube, so I do have to say like, subscribe, and hit that notification bell if you want to stay tuned and get notified of any new videos. So before we get into all that, it's important that you know why whole life insurance even exists in the first place. So it's exactly what it sounds like. It's to protect you your family financially for your whole life. So it was actually the first product designed by life insurance companies. Whole life is designed to protect you for your entire life. So you don't have, like when term expires, you have to, say if it actually winds up that you don't have enough capital to be able to pay death-related expenses or any other expenses later on in life, well, you're kind of screwed because in the insurance company's eyes, you're infinitely more risky to insure, and insurance companies are in the risk mitigation business. So your insurance is going to be really expensive, unfortunately. So whole life is designed to have level premiums from the moment that you put it in force until you die or you live to be 121, whichever happens first. Let me pull this up here. I have a couple illustrations that I'm going to share with you. What you're looking at here is an illustration for a 40-year-old male. They're putting $12,000 a year into this particular type of whole life insurance policy. $12,000 a year is just an example. It can be whatever amount. I just chose to use this for simple math. The reason that Dave Ramsey hates whole life insurance so much, I do agree with him on this, is because you have a lot of agents out there that are just blatantly dishonest and that will tell you that you're getting into infinite banking, and then they'll give you a whole life design like this because it's a higher commission than an infinite banking policy will be. What happens is you pay $12,000 with this particular design of policy. This is the traditional way of designing it. You put in $12,000 a year. First year, you have zero cash value. You have a over $1 million death benefit, which is fairly expensive for this kind of death benefit. But if you would rather have financial protection for your entire life, who am I to say otherwise? That's fine. Just know that a typical, like a term policy for about this amount for somebody this old will probably be like $55 a month. What's that math? $660 a year as opposed to $12,000. So let's get into this. This particular design of policy is not wrong. It's a good vehicle to use, especially if you're just wanting like some estate planning kind of stuff or just looking for financial protection for your entire life and not having to worry about your insurability later on. Like this is a great design for that. But if we're talking from the perspective of why Dave Ramsey hates whole life and why this type of design is not good for infinite banking, $12,000 a year, zero cash value year one, $12,000 year two, still no cash value. So at this point, we've paid in $24,000 over 2 years for this. And it's not until year three that we have, call it $7,400 in cash value to access, but you've paid in $36,000. Like that's a terrible, terrible ROI if that's the metric you want to think of this in. And the amount of premiums that you've put into the policy versus the amount of cash value that you have access to, that's called break even. This doesn't break even until year 17. And it's not even like, it'll break even sometime between year 17 and 18. Like that's a long time to wait to get an ROI on your investment. But not to confuse you, infinite banking is not an investment, it's a savings alternative. So let's get that clear. So this particular type of policy and dishonest agents are why Dave Ramsey hates whole life. Now, let's take a look at a policy design for infinite banking specifically, and I'll compare these side by side and I'll show you the difference. Okay, I'll compare them side by side here in a second, but let's take a detailed look at a policy design for infinite banking specifically. So if you remember, same scenario, $12,000 a year into this policy, but you'll notice there's a huge difference in the amount of cash value available. So year one, we have $6,700. If you're keeping score, you'll remember from the previous example, the amount of cash value available was a whole big goose egg at the end of year one. The end of year two, you've put in $24,000 right here. You have access to 15. Year 3, you've put in $36,000, you have access to 24. Now let's take a look at when this breaks even. So if we add in the dividends along with your premium, this policy breaks even sometime between year 8 and year 9. So you can see we put in $96,000, we have $95,000 available in cash value. So what I should have said in the beginning was, with this type of policy, this $12,000, 60% of it is going towards these dividends or these paid up additions. The other 40% is going towards increasing this death benefit here. So that's why you have so much additional cash value in this example versus the first example. So it's a completely different way to set it up. So what you'll also hear Dave Ramsey say is, oh, well, it has to be structured properly, as if that's a bad thing. Well, it's just a fact. Like, it has to be set up correctly in order to do infinite banking. So let's compare these side by side. If you're on a phone, well, good luck. I guess just watch this on a computer later on. But if you look over here on the left, $12,000, no cash value for 3 years, and you've paid in $36,000. With this particular example on the right, with the infinite banking, you have $6,700 available year 1. And then you break even with this between year 7 and 8, or I think it was 8 or 9. Either way, it's about half of the length of time as on the left. If you're even remotely interested in infinite banking, the agent that you're working with is a huge component of whether or not your policy is going to be set up properly. So I don't know if you remember when I mentioned that in a traditional whole life design, that's like max commission for the agent, because they're getting paid off of they're getting paid off of your premium, essentially. Well, with an infinite banking policy, if it's set up correctly, the agent that you're working with is going to receive anywhere from 60% less commission to 90% less commission, depending on how it's set up. Because the way that agents are incentivized to write these policies is, the more premium goes towards maximum death benefit, the more commission it is, because that's more money for the insurance company. To be quite frank, agents are not incentivized to write properly structured infinite banking policies correct. So that's why it's so important that you find an agent that knows what they're doing. So if you're even remotely interested in this, feel free to comment below. I'd be happy to have a conversation with you to see if this is something that could even work for your situation. If not, that's okay. I would highly suggest that if you're new to this, that you start with Becoming Your Own Banker by R. Nelson Nash. Go to the source for this type of material, draw your own conclusions, and if you know what's going on, you'll know what to do. So maybe this will be for you. Great. If it's not, that's okay too. It's not for everybody. Who infinite banking is for, it's for people that are looking for more control over their money. They want to say in how it grows, what they do with it. And in your typical financial structure for a household, you invest in, say, like a 401k, IRA. You can't touch that money until you're 60. You're going to get taxed on it. Taxes are set to go up in 2026. As of right now, we're looking at a huge deficit. And ironically enough, IRA and 401k contribution limits are going up by $500 a year next year. So I couldn't think of a better way for the government to have access to more tax money that they quite frankly don't deserve. But that's neither here nor there. So go to the source material, figure out what you would want to get out of this. And if it's for you, great. If it's not, that's okay too. But hope this was helpful.